Welcome to the fifth session of the Braces COGANAT Challenge. The session is titled Stocks and Bonds. So let's start first with the definition of an investment. Investments are assets or items purchased with the goal of generating income or appreciating in value over time. So one examples of these are stocks and bonds. So those are the two most common investment options by the investors. So first, let's define what is a stock. Stock represents a share in the ownership of a company. So when you buy stock, you essentially own a small part of the company. So the terms that you need to remember when dealing with stocks, we have share, the dividend, and capital gains. So when you say share, it is a unit of ownership in a company. A dividend, it is the portion of company's earning which is distributed to the shareholders or the owners of the company. Capital gains, it is the profit made from selling a stock at a higher price than purchase price. How stock work? Companies issue to raise money for growth, research, and operations. So when you own a stock, you can benefit if the company does well through price increase or dividends, but also risk losing money if the company performs poorly. So it will be dependent on the uh, performance of the company. We have different types of stocks. First, we have the common stock, and the second one is the preferred stock. The difference between these two, common stock provides voting rights. Meanwhile, preferred stocks does not provide voting rights. The common stock, no, in a company, they will be choosing or voting who will be the board of directors, and the board of directors will appoint or choosing who will be the president of the company. The board of directors, they will be managing the company as well as they are in charge in policy making of the company. So let's now go to bonds. When we say bond, it is a loan made by investor to a borrower, such as a company or government. When you buy a bond, you're lending money, and in return, you will be receiving interest payment. Okay, so you are just lending your money, so you do not own a portion of a company. So the terms that you need to remember are, first, we have the principal, it's the amount of money lent to the issuer. We have also the coupon rate, it is the interest rate that the bond issuer will pay to the bondholder. We have also the maturity date, it is the date when the bond will mature, and the issuer will pay back the principal. So how bond works? Bonds are often issued by companies or government that they are needing funds, maybe for expansion, for their projects, and other marketing strategies. Next, we have bondholders receive regular interest payments and are repaid the principal at maturity. And bonds tends to be less risky than stocks because but usually it offers lower returns. The different types of bonds, we have government bonds, corporate bonds, and municipal bonds. For government bonds, it is on the national government, corporate bonds by different companies, private companies, and municipal bonds by the local governments. The difference between stocks and bonds in terms of ownership. For stocks, you represent ownership in a company. You have a share on the company, small portion. For bonds, you are just representing a loan to the issuer. The risk level for stocks, it higher risk again because of the performance. It will be dependent on the performance of the company. For bonds, it is lower, but depends on the issuer on how high the interest that they will be giving to you. For the returns for stocks, definitely it must have or it can have higher returns due to the also the dividends. For bonds, it is has steady interest payments but lower returns. For voting rights for stocks, it often includes voting rights, especially if your stock is common stock. For bonds, there is no voting right because you are just lending your money. For priority and liquidation, for stock, it is last to be paid in bankruptcy, and for bonds, paid before. The risk and rewards often for high returns and capital gains. Some stocks provide dividends, offering regular income. For risk, high volatility, and the market and company-specific risk can lead to potential losses. For the risk and reward of bonds, for rewards, regular income through interest payments, and it is generally lower volatility. For risk, we have different type. Interest risk, rate risk. The bond prices decreases when the interest rate rises. So the default risk, the issuer may fail to make interest payment or return the principal. And lastly, the inflation risk. Fixed interest may lose value if inflation rises. So here are some practice example. First, under stock investment. So suppose you buy a share of a technology company for 2,500 each. So over a year, the stock price rises to 3,750 and you decided to sell it. So you have a capital gain of 1,250 per share. Okay, so let's suppose the price of a stock is 1,000 pesos. Okay, so each, no, suppose or you have a 1,000 share rather. So let's suppose you buy 1,000 share for 2,500 pesos each. So that would be amounting to 2,500,000 pesos. So that is the total amount that you buy. However, after a year, it rises to 3,750 for each. So you will be multiplying the 1,000 share by 3,750. That would be costing 3,750,000. So you gain a total of 1,250,000. Next, for the bond, for bond investment, you buy a 10-year government bond with a principal of 50,000 and a coupon rate of 5%. Each year, you receive 2,500 interest, and after 10 years, you get back your 50,000 principal. So that is an example naman for the bonds, no? So it is a government bond for 10 years, a principal of 50,000. You have a coupon rate of 5%. So each year you receive 2,500 in interest. So let's compute for 2,500. So after 10 years, so that would be 25,000, no? And you get your 50,000 would be returned after 10 years, no? So building a portfolio with these stocks and bonds. So you need to have a balanced portfolio. So especially when you are an investor. Many investors mix stocks and bonds. Why? Because it will show that their portfolio has balanced growth and stability. Stock provides growth potential, while bonds offer stability and income, especially in market downturns. So, stocks, since it has high returns or high rewards, it can have a potential growth in your business. And if you have bonds also as an investor, you need to say that you have have stable income, you have generated income through continuously. So age-based strategy, younger investors often allocate more to stocks for growth. And as investors near retirement, they may shift towards fund to preserve capital and reduce risk. So here are the different deals that you need to answer. So first, stock scenario, you purchase 100 shares of a company at 1,000 each. So after a year, the price rises to 1,200 per share. So and the companies pays a 50 dividend per share, what is your total return? So in this case, we will be just first multiplying the number of shares by the dividend because you have 50 pesos dividend per share. So 100 times 50, that is 5,000. Then each shares of a company costs 1,000. So 5,000 would be multiplied by 1,000. So that would be total of 5 million. Okay. So next, after a year, we will be computing the after the year. So same process, 1,000, 100 times 50, that is 5,000. 5,000 now will be multiplied by 1,250. So that it would be a total of 6,250,000. So the total return definitely would be, okay, so subtracting these two, we have 6,250,000 minus 5 million, that would be 1,250,000. The total return would be 1,250,000. Then, since we need to use compound interest for this because it is an annual coupon rate. So first, the total amount is P quantity 1 plus R over N raised to NT. So our P is 100,000 multiplied by 1 plus our R is 0.06 over 1 raised to 1 times okay, sorry for that interruption. That would be 1 times 5. Yeah. So we have 1.06 raised to 5 times 100,000. That is 133,822.56. So that was the total amount. Subtracting 100,000. So the investment is equal to 33,822.56 pesos. Yeah, that's it for the bonds. So next, again, stocks and bonds are two essential types of investment with different risks and rewards. So they have differences, and it can be helpful to make you to have informed decisions or investment choices. So that would be all for stocks and bonds. So we will be having a short quiz or short assessment, during our face-to-face class. Okay, that would be all. Goodbye.